every 5 minutes. You don't have to panic on every dip, and you can just let the market ride. You can let dips be dips. You can ride them out. You can reallocate. You can add swing trades on top. And that brings you into your trading part. So let's say you put 70% or 80% into your spot holdings. The rest, your 20%, your 30%, or whatever, will be for trading. I call this short term. Short term means anything, like I said, it could be 3 months, and it could be day trading, and it could be everything in between. But really, anything after January should be viewed through a short-term lens. That's why you will not be taking your salary and putting it all into long-term holdings. If you're going to take your money that you make, your income that you earn, in 2025, you should be looking at opportunities that are shorter term in nature, right? So say you get paid in January and you see a good setup for a coin breaking out and you think it could have a 6 or 12 week trend ahead of it. Okay, get allocated. Ride maybe the first few weeks of that and get out and take profit. Don't look at it and say, I'm going to buy this, I'm going to hold it to 2026 or 2027, because most likely you're entering at the later stages of that coin's trend or that coin's rally. And again, the later stages are the most violent. They are the biggest returns. These things can 10x in a week. But they can't 10x in a week and then keep going up for another 2 years. The time for that was 2022, 2023, and a little bit of 2024. So then you also want to split it between centralized exchange and on-chain. So depending on how you're going to approach this, majority of people will have, trades that they take on Binance and Bybit and Coinbase, centralized exchanges. And then you've got the on-chain stuff, which is predominantly like meme coins, but it can be anything. But anything that is on Solana or on Base or on Ethereum mainnet or whatever. All of that falls into the exact same bucket of trading. Again, now is not the time to, and I'm talking about once 2025 hits. Between now and the end of the year, you could still look at allocating stuff from a spot holding perspective, as long as the charts that you see are in consolidation, they're trying to break out, they're building up bases. I'll use a couple of examples here. So an example of this would be like APU, which is one. It just shows what I mean with this approach here. There we go. So you have stuff that is now breaking out from its essentially first wave, first consolidation for 7 or 8 months, and is breaking out from that. Now this probably, like I said, will go in a grinding upwards fashion to the end of the year. And most likely at that point, it's going to kick on and go massively higher. And then it gets a lot more volatile. It's a lot more choppy. There's a lot more deep 30%, 40% corrections as volatility massively increases. What you're seeing with coins here right now, if you see a coin that is breaking from its previous all-time highs after having a consolidation and after having many weeks of base building, so it's not in a parabolic blow-off top, it has had a run, it has had a consolidation, it's breaking out. These are the kind of things that should not go back to these lows, right? They should not fall back inside these ranges. It doesn't mean they're going to moon right away. And they should go higher over the next, whatever, call it 12 months. And that's where you should be looking to get allocated if you're going to have part of these in your spot portfolio, because this is the opportunity to get on board before it kicks on properly. For your trading then, once you hit 2025, anything you do in a centralized exchange, you're going to be looking at multi-week swings or 1 or 2 weeks or a few days or day trading. Depending on your style, you certainly do not have to day trade in a bull market. Far from it. That's why spot holdings will be the majority of it. But you're also not going to be looking at long-term opportunities once we get past, the first part of 2025. And then if you're looking at on-chain, it's the same thing. You're trying to identify, new meme coins or low caps or riding them up. Again, timing is everything. The reason why something like APU or many of these others have a better setup for 2025 than some of the new stuff is that they launched early enough. It's really important that a coin launches early enough, because then it's able to have its first wave, which shows that it can rise. Okay, so it has its first wave that shows it has attention and hype and interest. Then it has a significant drawdown of 85, 86% to wash out all the weak hands. It then has reaccumulation, and then it breaks out. The problem with something new, anything that launches in 2025, is it can have this part, and many of them will. So something that launches in 2025 can start off and have this major wave. Then when it goes down into its eventual 80% decline, it's going to miss the whole bull market. So what you'll see is something like that. So you're most likely going to see this throughout 2025. Loads of new stuff will launch and have massive trends, but they will have trends for maybe 6 to 12 weeks. They will have their inevitable 80% decline. The problem then is they will not get this second pump or breakout or continuation because most likely the bull market is over at that point or close to over. People are not going to be coming in willing to take massive risk or adding or buying long term because it's just a bad bet to hold and accumulate long term in late 2025. That's why your view should be short term in nature throughout 2025, and you're essentially just trying to ride momentum. You're not trying to hold these things or wait for 6-8 month accumulations. That is not really a good position for anything to be in for 2025. Now, stuff that is, and there will be coins like this, and this is the stuff that's going to pump at the end of the cycle. You're going to see stuff that will actually underperform for most of 2025, and then it will probably have a really big run at the end, at the later stages. So that's like your old shit, like Litecoin, and stuff that, the reason why a lot of this stuff marks the top of the eventual bull market is that it's very possible that Litecoin can run up here and go sideways here and go like that, and then when it starts to really run, that's actually the end, because it's missed all the opportunity to have a proper bull market. It's missed the opportunity to pump in mid-23. It's missed the opportunity to pump in this massive bull market wave when Bitcoin went to all-time high. Litecoin couldn't even break its 2023 highs. And so it's been in a very long consolidation. And eventually it probably will have a big breakout from that. But because of timing, that breakout will probably come later in the cycle. And therefore it's not going to be able to come down and have a reaccumulation because nobody's going to want to reaccumulate something in 2025, late 25. So there will be opportunities for stuff like that to pump later on in the cycle. That's something you should be aware of, though, that it's more of a top signal than anything else. So balance yourself between centralized exchange trading and on-chain trading. If you want to do just one or the other, that's fine. But understand they fall into the same bucket, and risk management is everything. Every trade you take should have predefined risk. If it's 1% of your portfolio, your trading portfolio, that's what you put in. 2%, 3%, whatever. You have to pick the numbers that you're comfortable with. You do not over allocate into things. You do not treat your trading portfolio as something of, I'm going to put it all into this meme coin and hold it, because that's your spot holdings. Trading is a way to capitalize on momentum in the shorter term so that you can outperform just straight buying and holding, but you have to have a profit-taking mindset throughout all of that. Do not use leverage for almost any of this, even for the centralized exchange trading. You should be looking at swings, okay? And swings can be a few days or a few weeks. And you're looking at coins that are going to go up by themselves. They're going to go up between 50% and 500%, even on a centralized exchange. You're going to see stuff that has large moves over multi-week timeframes throughout 2025. And using leverage is just a surefire way to get wrecked when we have one of these inevitable crashes that will come throughout the next year. Because this stuff is all hyper volatile. And when you get into the last period, right, the 2021, for example, with Litecoin, it is a time where Litecoin, if you allocated into Litecoin or got long Litecoin on the first dip in January, there was a 240% pump for the rest of the move. And Litecoin was one of the worst performers. And it still went up over 3x, right? And in between, the reason why you cannot lever these things, in between it had multiple, a 35%, a second dip of 25%, and a big shakeout of 37% before the eventual top. Leverage is not required, is not necessary. You do not need it. The market is going to rise so much by itself because of everything I said before, that leverage is not a factor here. The only thing leverage is going to do is put you in a position to actually lose money because you have a liquidation or a stop out price that's going to lead you into getting wrecked. Now, as a trader, especially like day trading and all of the things you're doing, if you build systems to scalp and day trade, yes, you use leverage in those instances for capital efficiency purposes, and you have a stop loss in that puts a maximum amount of risk per your trades. You all know this if you're in bootcamp, if you're at blue belt, purple belt. That all does not apply to this. That's fine. The point is, if you're going to buy and hold anything, whether it's a spot holding or trading where you're going to hold something for a few weeks, you're not using leverage. If you're saying that I'm going to buy Litecoin or fucking Cardano or Popcat or whatever, because my system is telling me there's a setup where this can outperform for 6 or 12 weeks. Do not use leverage, because the market will do the work and you won't wake up one morning, stopped out and watch as it goes higher. The market's going to do the work for you. And that's really it. Focus on risk management, so minimize your downside. The only thing you need to do to minimize downside in the next year is not use leverage. Okay, don't use leverage on your spot holdings. Don't use leverage on your trading portfolio unless it is for like scalps and day trades and you have a stop loss in. And keep an eye on everything else. Have an invalidation. If you're in the lower cap stuff on chain, your invalidation is going to be like 50 to 100% lower, because this stuff is like basically rug to zero or go to 100 million. And if it's for on-chain or on centralized exchange, I should say, you know that these things can have a 30% down candle at any point. So it must be spot only, and you must be able to withstand the volatility that comes in between. Beyond that, getting out of the market is more important than getting in at this point. Again, you've probably got a few weeks left to get in, or if you're not already in, your spot holdings should be getting, allocated. After that, it's all about getting out. It does not mean you don't ride it. It does not mean that you don't stay long, but your focus in 2025 should be focused on getting out. How do I start to actually realize some of these profits? Because whether you like it or not, that's what everyone else is going to be doing. And the nature of markets is not to be, here's what I want to happen. It's here's what is happening. Here's what's going to happen. Here's what's most likely to happen. What's most likely to happen is that all the smart people are going to be taking profits in 2025 slowly, right? They're going to scale out. They're going to ride the pumps, but they're disciplined and diligently going to be taking profit. If you are only getting in now, it's easy to overstay your welcome. Because in your mind, like, you might think that April of next year is not that far away, right? Because you get in November and then it's April. You're like, I've only been in 5 or 6 months. This could keep going. But you have to remember that there's people who've been in from the bottom of 2022. So for them, it's 2.5 years in. And they're up many multiples more than you. And they're going to be taking profit. Again, you can't go back in time and change things. So you just accept that that is a fact. And you make sure that you're disciplined about getting out as much as you are about getting in. And overall, be comfortable with the amount of risk you're taking, because you're going to have to withstand volatility. So before you put anything in, or if you do have your money in, you have to also be aware, like I said yesterday on the part 2, you have to be aware of how much you can lose. And you have to stare that number in the face and say, if this all goes completely wrong, my spot holdings will drop by whatever, 50%, and I'll exit there. And you say that would be this amount of dollars, and literally state it to yourself. I've got 10 grand, it's all into spot, and I've got 20% on the side for trading. And if it's all completely wrong and everything goes down 50%, then I'm out and I've lost 5k. Am I comfortable to lose 5k? Is it okay for me to lose 5k? Because if it's correct, I could make 50k. Or 25k or 30k or 40k, whatever, right? The upside potential, like I said, yes, the upside potential is much greater than the downside. Come to terms with that. Say that that money is gone, because once you put money into the market, there's no guarantee you get it back out. Accept the risk and then understand you've got a plan, you stick to the plan, and when all this crazy shit happens over the next 6 or 12 months, you do not deviate from that plan. And you do not deviate from the plan of taking profit as well. If you've told yourself that once we get to May and June of 2025, you're going to start taking profits, regardless of what the market's doing, you stick to that plan. If you've said that no matter what happens by this time next year, by November of 2025, I'm going to be mostly out and I'm just going to be short-term trading this because it's probably on the dying breath if we're even still going up, you stick to that plan. If something else comes along and happens, and it will, because the thing will happen where people exit too soon and then it goes higher again and then they think of reallocating fully at the top. And this is the last thing I'll touch on because this happens every time. There's going to come a period where you feel like this time is different. The 4 most dangerous words in markets. And it will be something like this. And it will be something like somebody gets out and maybe they even get out really well. Maybe someone exited the majority of their bags over here and they nailed it. And then it crashed down, they feel like a genius. And then it rallies up and they're like, I think this is a lower high bounce. And then it goes there and they're like, I was correct, it was a lower high bounce. And at this point, they've ridden the bull market all the way from 2020 until May, and they've caught most of the good move, and they got out near the top, and it's all gone well, and it comes up, but it doesn't make a new high. And they're like, great. And then it makes this, and it goes up above these highs. And again, with hindsight, you're like, no, I would never do that. So many did. Where it flipped this and started to move up, and they're like, holy shit, this time's different. Holy shit, we're going into 2022. Holy shit, this is not going to stop. This is just a breakout, confirmation, it's holding. And they get back in. And they eat a major drawdown, by the way. Because it doesn't take much if you don't have discipline. It doesn't take much to lose a significant portion of the money you've put in. Just looking at the total here, if you got in at the same time as where we are now, if you got in November 2020 and you wrote all of this up, you could have had a 5x, right? So you put in 10 grand, you've got 50 grand. You get out near the top and you've got your 50 grand. You're like, oh, that's amazing. Such a good move. I've nailed it. I've increased my portfolio. Then it starts to go up. Then it breaks out. Then at this point, you're like, holy shit, I need to get back in. And you put the 50 back in. Well, within a couple of weeks, that's down 30%. These are 3-day candles. Within 3 weeks, it's down 30%. Minimum. And suddenly, your 50 is now like 30. And you've given away a lot of the money you just disciplined and diligently made throughout this period here. If you think this can't happen to you, it can. So make sure that whatever plans you have, you stick to them. If this is the last phase of upwards accumulation before the blast off, get yourself allocated. If we get into 2025, do not be piling more and more and more money into a market that is probably going to go from PVE to PVP. And understand it can end at any time. Maybe it does crash in May this time and it doesn't come back in November. Your goal is not to predict. Your goal is to have a plan and stick to it. And the plans you lay now, the foundations you lay now, are the ones that are going to serve you best. Because when we revisit this in 6 months, everything's going to feel different. There's always going to be a reason why you don't want to exit. You're always going to want just a little bit more. You're going to see your portfolio grow from 10k to 80k, and you're going to, I'll get out when it's 100. No, you won't. You will not get out when it's 100. You will get out whenever your plan says to get out. Do not start to trade your P&L. Or if you've got 50 grand and it goes to 600k, do not say, I need $1 million. I'm going to hang on for $1 million. No, do not start to trade your P&L. Stick to your plans. The plans you lay now, when you're sober and you've got a rational mind, these will be the ones that will serve you throughout the bull. And that's it. GM.